Hello and welcome to the last of our Minds and Money 5 at 5 shows, sponsored by Sprott. For those of you attending 5 at 5 for the first time, the aim is to maintain engagement between investors and miners through a lively, interactive format during the current situation. A few admin announcements before we start. To make it as interactive as possible, please have your video switched on. To ask a question, you have two options. You can either ask the question in the chat function at the bottom of the screen, or also you can click on the invite, or you can click on the participants button. You can go and wave your hands and I can unmute you and invite you to go and ask your question live. We have a star-studded lineup of guests. So just to run through as to who we have for today's show, we have Jose Vizquerra, CEO of O3 Mining, Darin Labrenz, CEO of Pure Gold Mining, Walter Coles, Chief Executive Officer of Skeena Resources, Bruce McLeod, Chief Executive Officer of Sabina Gold and Silver, Derek White, President and CEO of Ascot Resources, Rick Rule, President and CEO of Sprott US Holdings, and Joachim Berlenbach, Portfolio Manager of Earth Resource Investments. A warm welcome to you all. Right, so let's move on to our first mining update of the show. Jose Vizquerra is CEO of O3 Mining. He won the Peter Monk Young Mining Professionals Award in 2019. O3 Mining, which forms part of the Osisko group of companies, is a mine development and emerging consolidator of exploration properties in prospective gold camps in Canada, focused on projects in Quebec and Ontario, with a goal of becoming a multi-million ounce high-growth company. Over to you, Jose.
Hi, Andrew. Thank you very much for the introduction. O3 Mining is a company that is mostly based in these three pillars. These three pillars are the quality of management. We're all very technical. We're all very driven. It's a company that has a record of success. One of the few groups that has been able to identify, discover, develop, and put into production a mine like Canadian Malartic that was subsequently sold. We were able to reinvent ourselves and move on. We have been able to raise money. We are sitting now in $61 million, which will allow us to execute a plan, which is very important when you want to be systematic. And of course, we have 5.2 million ounces of gold in the ground, which are a very good number of ounces. And not only that, but are very economic ounces. If we move to the next slide, it is very evident that these ounces are, of course, in valor. We are working towards a PEA in the case of Marban, which is under our Malartic property. We have these three main buckets where we operate. We're taking into production Marban. First step is a PEA. We're developing the resources in the case of Alpha. And we are moving in the case of East Cadillac to expand the footprint of mineralization that we have in our projects. So it's a very unique company where we have right now an enterprise value of only $90 million when we have 5.2 million ounces of gold. So most important thing, I would like you to focus in the PEA. We are about to release the results in the next couple of days. And more important is to know that this company right now, as you can see, it could be a $30 to $40 per ounce. Once the PEA is out, we're going to be talking about complete different numbers in terms of valuation, and the exploration potential of this company is very, very important. If we move to the next slide, we can see that we not only have Marban, but we also have other deposits around that we will continue to explore. So therefore, Marban will grow dramatically, not only in size, but hopefully in grade as well, which will allow us to have even better numbers than the ones that will be released in a couple of days, and will show the potential. Once again, the value that will be pinpointed out of the PEA will carry the exploration of the rest. So with that, I will leave this to you, Andrew. I hope I didn't take too much time.
No, that was absolutely great. So first question is from me. With many explorers in the Val d'Or camp, what is the value proposition that O3 Mining brings to the table?
Multi-million ounces to be discovered with a team that has proven to be right in the camp, and where we have the ability to be systematic in the exploration with the right amount of drills and the right amount of money. I think the difference that we bring into the table is the ability to execute. There's been many junior mining working in Valdor, and they never had enough money. They didn't have the teams to do the job. We of course go through a very cyclical times with the gold price. So of course, at some point, people just want to go put one drill, get results, raise money, and just stay there. What we want is to put mines into production. So our view of the market is a very different view.
Okay, I'd like to bring in investors. Joachim, do you have a question for Jose?
Yes. Hi, Josie. Thanks for your presentation. And I went through your main presentation also before this conference on your webpage. And I need to go a step back here where we're coming from. I'm based in Europe. We are dealing with a lot of, or exclusively with European investors, which are very ESG focused. So one hurdle we currently see is that for many investors that we speak to, mining stocks are still sin stocks. They say they're polluting, they have a huge CO2 impact, and lots of these investors are actually excluding mining stocks. Very difficult for us as portfolio managers and portfolio advisors here in Europe. Now, on your webpage, you say on page 4 here, in that main presentation, O3 Mining is committed to protecting the environment and performing activities with very low carbon footprint. Now, you're going to have open pit mines, which are by definition higher in CO2 footprints. Can you tell us a little bit how you get to this, being an open pit miner, and then at the same time saying you are a very low carbon footprint producer? How does that fit together?
Well, first of all, we do believe in the ESG system. We do believe in the idea of environmental, social, and for us, it's a very important part of our DNA. We are not into production yet. We are an exploration and development company. We will be putting a mine into production, which will be an open pit. The fact that it is an open pit does not make it a high carbon emission. We have to take into account of what is the activity that is being done to be judged on how much carbon footprint you will have. What you will have to do is to analyze now if you have an open pit mine, if you are going to be using as much electrical vehicles or not, if you are going to be using most of the hydropower instead of burning fuel. There is a bunch of characteristics that you need to add into the global context before we talk about high or low. When we refer to low is the fact that if we are doing exploration, we rather spend more time in analyzing the different options by doing artificial intelligence before we drill everywhere. So we can focus in area where we can drill, we can impact the least that we can and move forward.
Okay. I mean, that's very laudable. If you go electric and hydro, I mean, this would be an important step forward, I think. So it's something that we really look forward to observe and watch. The other issue that strikes me is that you have in your area, you have a lot of different deposits. Some are high grade, some are low grade. The metallurgy seems to differ between the deposits. What does the final ore, what does it look like that you sent to the mill? Have you got a feeling already with regard to the metallurgy, payability, these kind of things? Is that something that we can forecast already, or is that still work in progress?
Yeah, well, Marban has been a project that has been worked since 2012. The amount of knowledge we know about the project is quite vast. We do get good recoveries. There has been studies since 2012 until 2017, which shows that we get recoveries around 93%. It is very important to mention that the ore at Marban is a very docile ore, so it's very easy to treat. We get over 30% gravity, and the rest is through a regular CIL. So in terms of metallurgy for Marban in particular and the Malartic area in general, it's quite simple, quite docile.
I'd like to bring in Rick Rule. Rick, do you have a question for Jose?
A bunch. I'll try and I'll try and whittle down the list. Jose, you come from an investing family, and one of the things that interests me, traditionally, the Osisco Group has been very aggressive in exploration, very aggressive in fundraising. Now that you have established some values and will better establish the values with the PEA, how does the decision-making work within the Osisco Group and also within your boards about when to raise money and how to dilute? In other words, yes, you need to raise money to increase the certainty with regards to your deposits, but when you raise money, you dilute the existing shareholders' percentage interest in the deposit. So I'm interested in how the calculation comes about, the sort of per share benefit calculation as to when you raise and how you raise. What is the sort of, what's the internal calculation between dilution and growth?
Well, there's two very important things to be mentioned there, Rick, and you well mentioned I was very fortunate to be born in a family where my grandfather started a mining house in 1952 called Buenaventura. It's listed in the New York Stock Exchange, and Buenaventura has not raised money since they went public in 1996. So there is one way of looking at the things. In where I am at Osisco Mining, we raise money when it's needed. So certainly there is a different philosophy. If you don't have money, you cannot increase the value of the company. So there you have the chicken and the egg. Now, when is the right time to raise money? Well, it will depend on how we are advancing the projects. Right now, we have $60 million in the bank. We are extremely cautious on how we use the money in order to maximize the value for shareholders. In my view, I am of the idea of managing dilution the best we can. I don't think here the idea is to raise money for raising money. I don't think it's the case of any of the things that we have been raising money in the case of Osisco, in any case. But to your point, we'll be extremely cautious on how to raise the money and when to raise the money. I don't see us raising the money for quite a bit some time. We are focusing in generating value through the drill bit at this moment.
Do you have a calculation internally that says we are worth approximately X per share at a certain gold price, and we won't raise under that number, but we will raise above that number? How does the calculation as to whether you'll raise or not take place? Or do you simply raise capital on an as-needed basis?
No, we usually use we as O3, we use the calculation of having the NAV, our internal NAV, at we should always raise it at par of where we are in terms of our internal NAV. So this means, for example, right now we are worth at $2.4 per share. Once we put out the PEA, you will know that immediately there's a fundamental value that will take us to internally at least $5 or $6 per share. We will intend not to raise money until we reach that value. So with that, then we can add more and keep growing. So you keep growing the company on the basis of fundamental value. You dilute only in terms of growing the fundamental value. There is no need to dilute if you are not growing the fundamental value. But said that, there is also a very important principle that once I heard. And the only time that you actually get diluted is when you don't participate. We as O3 were one of the few companies where management actually has 6% of the company. It's mostly my family. And we have not diluted ourselves because every time that we have raised money, we have contributed.
Thank you.
Thank you very much for that. I think in the interest of time, we just need to move on to our second mining update. But if anyone does have any questions for Jose, they can post them into the chat function at the bottom of the screen, and Jose will be more than delighted to ask any questions that you have for him. Our second mining update is Darin Labrenz, CEO of Pure Gold Mining, who on their website say they are 17 weeks away from production and plan to have their first gold pour by Christmas. Over to you, Darin, for an update.
Thanks, Andrew. Yeah, we are building the Pure Gold mine in Red Lake, Ontario, and we are fully funded through to production. We've very much taken a phased approach to building our mine, with the first 1 million ounces, which will start pouring before Christmas, coming from a broader 2.1 million ounce indicated resource. and a 500,000 ounce inferred resource. And so just in the short time frame that we have here, I want to introduce a few concepts. We'll talk a little bit about the team, location, grade, scale, and growth. You know, from a team perspective, we have 6 individuals on the board and management team with deep Red Lake experience. And I think that's really been a key driver for the success that we've had thus far as we sit here on the cusp of production. But more broadly speaking, this is a team that's got deep operational experience. We did a poll across the group, and there's 68 mines across the world that we've operated. And so this is a company that can move through that curve from exploration through development and into production. With respect to location, Red Lake, Ontario is it's an area that's had over 100 years of continuous mining, and we benefit from the services that are available there. But importantly, from a geological jurisdiction perspective, there's 30 million ounces of gold that have been produced in Red Lake, and it's some of the highest grade gold that's been produced on the planet. So it's a good segue into grade. Our mine will be 1 million ounces at 9 grams per ton diluted. And we compare that around against operating mines across the world, that puts us as number 5 in Canada or number 17 in the world with respect to grade. So that's about the 95th percentile. And obviously with gold prices being quite constructive, and particularly in Canadian dollar terms, that's driven incredible margin expansion over the last year. So we think we're perfectly timed for production. From a scale perspective, you know, this is an asset that we've defined a 7-kilometer long mineralized corridor. We have discoveries that sit outside the footprint of our phase 1 mine. And so clearly with 2.5 million ounces of historic production and 2.1 million ounces of indicated resource, this is a large system that we think is got clear pathway for growth. So that's the last aspect or theme that I want to touch on is growth. You know, again, I indicate we're building it in a phased approach with 1 million ounce reserves carved out of that broader resource. We have discoveries outside of the phase 1 mine that we've already built resources. We've done early stage engineering work. We're thinking about how we'll expand. And that work is continuing with a very aggressive exploration program with $15 million in expenditure between now and the end of the next year. We're looking at a program that's about 30 to 50,000 meters, really driving towards that growth in the next phase of our mining operation. So with that, I'll throw it over to questions.
Thank you very much for that, Darin. Perhaps I can go to you first, Rick. Do you have a question for Darin?
I do. It's similar to the question that I asked Jose. I too am excited about the growth characteristics that you have available to you at Red Lake, and congratulations on the amazing job that you've done in a fairly hostile early mining environment in terms of raising the production finance that you were able to accomplish. What I'm interested in is the same sort of thing that I was interested in with regards to Jose. Once the valuations have been established from production, how do you decide whether or not to raise capital for exploration? Is your intent that exploration will be self-funded from production cash flow? Do you establish an NAV per share internally and do some sort of benefit cost analysis in terms of capital raises? I'm interested in value management and capital management going forward.
Yeah, no, you're absolutely right. It's been a difficult environment, and you know, I think we've been quite counter-cyclical, being able to raise the funds to move our project forward in a difficult market, and now we're sitting on the cusp of production and ready to benefit from the movement in gold price that we've seen over the last year. We are fully funded through to production. We've got a strong buffer in place and a $15 million budget established for exploration, as I said, over the next 18 months. And really, growth is a driver for us. We think we have a very strong organic growth platform in front of us. But with first production Christmas this year, commercial production in Q1 of next year, we believe that our growth aspirations will be fully funded from cash flow from the mining operation.
And how would you make a decision between distributing some capital back to shareholders versus capital expenditures in your project?
Yeah, I mean, right now, again, we see the real value in terms of driving towards that second phase of our mining operation. You know, internally, obviously, we're looking at the resources that we have outside of that phase 1 mine footprint. We've done some work to look at how they might be mined, what the capital requirements would be, and importantly, what the impact on the overall NAV of the project is. And so when you look at that, you know, I think that the real value investing in Pure Gold is near-term cash flow, but the growth that comes beyond that as we move from, you know, 100,000 ounce per year producer towards our goal of 150 to 200,000 ounces per year.
Thank you.
Joachim, do you have a question for Darin?
Yes, and a technical one actually. So I'm always intrigued, especially in the Red Lake area, how the geos and how the technical team are thinking about the structural model of their deposit. Now you show here 10-kilometer trend in a long section here. We see one area that's highly populated with drill holes. We see one borehole here, 14.3 grams over 2 meters. Going forward, I mean, for lots of investors, it's important to see the upside. What's not yet in the share price? Where can you find more deposits? We saw that trend, that development with Great Bear Resources, for example. Also, it's the upside that's there. Where's your focus here? Do you plan, and it goes a little bit into the question that Rick asked, are you going to spend more on drilling? Are you going to surprise the market, investors, by more high-grade shoots, or do you focus on getting this project up and running now and started? What can we expect here?
Well, it's kind of a unique opportunity in the sense that we're doing both concurrently. So we are fully funded through to production, and that's job number one, is executing and bringing the mine into operation. But we are running a concurrent exploration program with 2 rigs on surface turning right now towards the south end of that long section you described, and one underground looking to drive near-term growth within close proximity to our existing development. It's interesting when you talk about that long section, and you mentioned 14.3 grams per ton over 2 meters. You know, that sits at 2.1 kilometers vertical depth, and yet our resources and reserves are defined down to about 1 kilometer depth. And so longer term, that's a real opportunity for growth for us, is continuing to follow that deposit downward. So I think in summary, you know, we're in a position where we're well funded, we're focusing on execution, we're going to drive towards that cash flow, but we're thinking already about where the growth is going to come from. And towards that end, we've got a very aggressive exploration program.
How many meters do you want to drill this year?
We'll be drilling 30,000 meters before the end of February, and then likely you'll see that program expand to about 50,000 meters over an 18-month time frame.
And that's going to, the focus will be along this long section, or you got any external targets also?
There's some external targets across our 47 square kilometer property. We've got about 12 targets. We continue to move towards you know, drill ready status. The focus right now is on these resources that are currently defined, that sit outside of the phase 1 mine, because we see a very near-term opportunity to bring those into a future mine plan, you know, potentially through a plant expansion, driving that production profile.
Mm-hmm. Thank you.
Question from the audience. You're part of the Oxygen family. What does that mean for Pure Gold?
Yeah, again, that speaks to the team. You know, this company was co-founded by myself and Mark O'Day, and Mark O'Day is a founder of Oxygen Capital, which really is a company incubator, if you will, and it retained a key group of very strong people within the group to look at different opportunities. From Pure Gold's perspective, I mean, we're independently operated and managed, but it allows us a broader, more diverse skill set to draw from and drive the project forward. So it brings a lot of opportunities being within this group.
Okay, and just one last question from myself. Red Lake is known for dual endowment and complexity. How confident are you on your resource modeling, and what risks and upsides comes with that?
You know, that's a great question, and I'll answer that with 2 parts. One, team. So our team again has really strong Red Lake experience. I was chief geologist at the Campbell mine, part of the Red Lake mine complex, and so I have a good, strong understanding of the complexities of the Red Lake area. And again, we've got 6 members on the team with that deep experience. So I think that's job number 1, is to have a good, strong understanding of those complexities. The simplest answer to the question, though, is drilling. When you look at our resources and reserves, we have 1.3 million meters of drilling that's gone into defining this deposit. Within the reserve footprint, we have drill hole every 6.5 meters, which is absolutely incredible. When you think about the density of drilling that we have, that informs our geological model. And so that gives you, you know, not only a really good, solid understanding about the grade, but also the continuity and the geometry of it. Last comment is we also tested it through test mining just to get a good reconciliation against our resource model, and it's reconciled beautifully.
Well, thank you very much for that. I think in the interest of time, we need to move on to our next mining update, but you'll see down there's kind of a few questions that have been posted by members of the audience. So I'll allow you to answer those questions offline to those audience members. So thank you very much for that update, Darin. Moving on to our third update, it's from Skeena Resources, who are a junior Canadian mining exploration company, focusing on developing prospective precious metals properties in the Golden Triangle of Northwest British Columbia, Canada. Walter Coles is Chief Executive Officer for Skeena Resources. Over to you, Walter.
Andrew, thanks for that introduction. We're going to go through just a couple slides here. If we could just move on to the next slide. There we go. Perfect. So Skeena has two projects. Our flagship project is called Ascot Creek. The other one is called Snip. These are both past producing mines that we optioned and have acquired from Barrick Gold Corp. We're in the northwestern portion of British Columbia, the Golden Triangle. Part of the reason that we love being up there is the improvements in infrastructure that have occurred over the last decade. For instance, between our two projects, we've got 3 new hydroelectric facilities that recently were built and sold at a price of about $2.5 billion US. Our Ascot Creek project is 7 kilometers down an existing road to one of those 3 facilities. So it's an incredible game changer for us. When these projects were in production back in the 1990s and early 2000s, they were both powered by diesel and propane. Now we can plug into cheap, clean hydroelectric power. The other obvious advantage of brownfield sites is we have the roads, so you can drive in and out of Ascot Creek. We can drill year round there because of that investment in infrastructure that's already occurred. So it's an incredible advantage to have that infrastructure and yet be in the far north where there's not a lot of people and population. If you find a deposit here, you can get it permitted, you can get it built. Moving on to the next slide. So I mentioned Ascot Creek is our flagship project, so I'm mainly going to focus on that. Here's our resource that we put out last year. It's primarily an open pit resource. It's around 4 million ounces gold equivalent. It's about 80% gold and 20% silver right now in terms of value. As the price of silver goes up, then that sort of shifts a little bit. Right now, in terms of indicated and inferred resources, it's evenly divided on tons, but about 2/3 of the ounces are in the indicated category. And it's important to note that the grade on our indicated is almost 6 grams per ton, and the grade on our inferred is 3 grams per ton. That's partly a consequence of drill spacing. As we do infill, we expect to see an improvement in that inferred grade. And we have a 90,000 meter drill program underway. And our goal on the other side of that program by the first quarter of next year is to increase the size of our deposit up to 5 million ounces and raise the grade to 5 grams. And if we achieve that, that's a pretty phenomenal open pit grade in a politically stable jurisdiction of Canada. So we think it's a very rare project. Moving on to the next slide. I'll just talk briefly about our PEA that we published last November. Obviously, gold prices are rising pretty fast right now, but when we did this PEA, we used a $13.25 gold price and $16 silver, and we came up with an after-tax NPV of $638 million, and that's on top of a CapEx, a US dollar CapEx of $233 million. So the CapEx is low, and that's because of the infrastructure that already exists. We're certainly benefiting from that. And the consequence is that we get a very nice IRR, 51% at $1,300 gold, fast payback on capital, 1.2 years. What's also worth noting is you can see on this slide what happens when you input a higher gold price, higher silver price. If we go to close to spot, $1,900 gold, $23 silver, you can see the after-tax NPV almost triples to 1.5 billion, and the IRR is 89%. So it's a very robust project, even before we grow it, make it bigger, and improve that grade. So thanks for the opportunity to present the project to you guys.
Thank you very much for that. Joachim, do you have a question for Walter?
Yeah, I must say, I mean, we followed Skeena for quite a while, and we like the deposit, we like the grades. I wasn't aware of the sensitivity. I haven't looked at that previously, so this is obviously all very impressive. But as you said yourself, Walter, it's the permitting, and that's what's keeping us away here a little bit from it. Is permitting is an issue. You just highlighted that yourself. If you get it permitted, then you can build it, then you can build a mine. Where are you on the permitting side? What are the next steps? And I'm sure you spoke to your Canadian and North American investors quite in detail. But maybe you can, for us in Europe, you can just highlight a little bit what will be the next steps on the permitting side.
Yeah, well, the way I got comfortable with permitting in BC, at least of recent years, is I look at the other examples of projects that have gone through the permitting process. Most recently, Pretium was permitted in a 2-year period from when they got their applications in. I've had the province tell me that they want to improve on that, and I think it's especially during this time of COVID, where we've seen economic downturns. Mining is viewed more importantly in British Columbia. You can't have social programs unless you have tax revenue to pay for it. And our project will generate, over a 9-year mine life, using $1,700 gold, our project will generate $971 million of tax payments. And 2/3 of that goes to the province. And of that 2/3, about 20% goes to the Tahltan First Nation. So there's a real economic incentive for the province to help us get this permitted, and it's something the province is keen to make an example of how quickly. I think they're keen to make an example of how quickly they can get Eskay Creek permitted. It's a brownfield site. The advantage of that is, as an example, is our tailings facility has an active permit today. Like, it's got plenty of capacity. That's usually one of the most difficult things to permit with a project, and that box is already checked for us.
Mm-hmm. One technical question still on the concentrate. I think you had some mercury in there, arsenite and so on. Is that an issue? Is how you deal with that? Have you got takeoff agreements here, or what's happening there?
Yeah, a great question. We get this all the time because Eskay Creek had legendary grades, but it also had a legendary reputation for some impurities and deleterious elements that would come along in the concentrate. But the key thing here for investors to understand is that there is a correlation between grade and deleterious elements at Eskay Creek. Historically, it was an underground mine, and Barrick was mining at a 75 grams per ton grade. So 2.5 ounces per ton was the average grade that came out of Eskay Creek. And with that were very high levels of deleterious elements. In our case, we have an open pit. We reduced the cutoff grade down to 1.5 grams, where Barrick was using 15 to 30 gram cutoff. And so, again, our average grade is 4 grams. In Barrick's time, it was 75 grams. So we are dealing right away with a much lower quantity of impurities. The second really important point is that there are two horizons with mineralization. The first is called the contact mudstone, and then below that is something called the rhyolite. And Barrick only focused on mining the contact mudstone, and that's where you get the very high grade. They mainly mine that out. So what we're left with is primarily the rhyolite, which coincidentally doesn't have any deleterious elements. So we only have impurities in the first 3 years of the mine life when we're mining the remnants of the contact mudstone. And then by year 4, it's gone. So we're dealing with a fraction of the impurity levels that Barrick dealt with, and we're only dealing with them for the first 3 years. In terms of your other question about, do we know if we could sell the concentrate? We've had numerous term sheets for life of mine offtake for the concentrate from Eskay Creek already. The way I view it is that when so many people are eager to get us to sign life of mine offtake agreements, that I know there's good profit margin in it for the concentrate traders. So we expect to run a very competitive process, and through that achieve the best sort of offtake terms and net payabilities that we can get for this project.
Okay, so you're in discussion with a few off-takers already.
Oh, yeah. Yeah.
Great, thank you.
Rick, do you have a question for Walter?
No, I do. Mercifully, my first question was already answered with regards to the concentrate. It would appear that one of the reasons why the upfront capital cost is so low is because you are able, as a consequence of grade, to sell the concentrate with some of the impurities in the early years. Is that the correct assumption?
Yes, that's correct. The penalty level in the first year, based on our estimate for concentrate values, is around $75. That's on the arsenic and the mercury. But keep in mind that's on a concentrate that has an ounce of gold. So the value of the con that we're shipping is like, call it $1,800. And yeah, sure, we get hit with a penalty, $70. It hurts, but with the grade, as you mentioned, we can absorb that penalty and still have pretty attractive returns.
And obviously, as a consequence of the new infrastructure in the area, the roads as an example, those concentrate shipping opportunities open up for you where they didn't exist.
Yes, and I'd also mention there's the deepwater port at Stewart. It's the most northern all year round deepwater port, and Pretium is using that port. Ascot's planning to use that port, and we're very lucky. That port was modified and upgraded in anticipation of Galore Creek and Seabridge, some of the other very large projects that haven't come into production yet. So we're a small high grade project, and we can easily take advantage of all that existing infrastructure.
My real question now involves ESG, and in particular, First Nations relationships. I'm very impressed by the new young chief of the Tahltans, and I'm delighted that you and they have been able to convince the provincial government to share some of the benefit. Normally, the capital gets the rent and the regions get the shaft. If you could describe something about the nature of your First Nations relationships with the Tahltan, the Shkukum Laksha, if they're necessary for you, and the Nishka. I want you to talk about First Nations engagement, First Nations employment, and the possible participation of the First Nations in moving along your permitting. They were very, very useful to Pretium, as you'll recall.
Yeah. And the way I view a natural resource project is if you're going to get it permitted, all politics are local. If you don't have the local groups on side, it's just, you're gonna face a lot of challenges. So our view at Skeena is the only reason we would continue to advance a project in this territory is at the convenience and leisure and with the approval of our local host, the Tahltan. Our projects are almost 100% in Tahltan territory. So they are the group that we consider our partners. We are working with the Tahltan to hopefully have them become equity investors in Skeena. Our view is we want to do more than just provide jobs. We want them to benefit in the profits that are made out of these projects in their territory. I think that Chad Day and myself were both sort of younger guys, and I think that we want to do it innovatively. We want to build projects where everybody shares in the benefits in every aspect, not just the jobs.
Thank you.
I think we need to move on to the next mining project update. But that was a really, really great summary, Walter. You'll again see in the chat box there was a few questions from members of the audience we weren't able to get around to asking you. So if I can just invite you to answer those audience members' questions. But let's move on to our fourth mining update of the show, which is from Bruce McLeod, Chief Executive Officer of Sabina Gold and Silver, a Canadian precious metals company on track to become a mid-tier gold producer. The company has a portfolio of properties in Canada at different stages of development. The company's flagship projects are currently located in Nunavut in the Canadian North. Over to you, Bruce.
Thank you very much, Andrew. Today I'll give a brief overview of Sabina and our outlook and some basics about the asset and why we're excited about it. A lot of work's been done on this asset. We've spent about $350 million advancing it since acquisition in 2009. We've grown our resource from 2.2 million ounces to today 7.2 million ounces in all categories at over 6.2 grams. These are the highest grade undeveloped permitted open pits of over 500,000 ounces in the world. also haven't stopped adding value, continue to do resource expansion, resource optimization. And if you can forward to the next slide, that would be helpful. Again, I think one of the other things that distinguishes ourselves from other developers is this project is now fully permitted, not only for construction, but now for operations, with our last permit being our tailings deposition received earlier this year. It's shovel ready. We've also obtained social license with our local landowner, which is the Kitikmeot Inuit Association, having signed a 20-year Inuit Impact Benefit Agreement with the Kitikmeot Inuit Association. Nunavut's certainly a great mining jurisdiction in terms of security of title, in terms of permitting, in terms of settled land claims, which gives more clarity and more certainty to projects. A lot of the critical components of infrastructure, and infrastructure is one of the bigger challenges of this project, we've now put in place ourselves. We built the port facility, now built and operated our winter ice road. So we've tested our entire supply chain from our consolidation points in the lower Canada to site by land and by sea. The economics of this project were completed on a feasibility of $1,150 an ounce. And I'll speak more to what it looks like later. And certainly for a lot of the programs that we have ongoing today, in terms of moving the underground forward, bringing that higher grade ores out earlier, in the additional infrastructure, detailed engineering, that will come out of Treasury, where on the last quarter we ended with 75 million Canadian. We can go to the next slide, please. A sensitivity from our feasibility, and that showed an IRR again at over 24.2% at 1150 gold. So certainly we have the downside covered. And if we take a look at numbers on that, 1600 to 2000, you can certainly see what effect that has on the project. Certainly not only by the NAV, but the IRR. But one of the things that we've been very successful with in the last 3 years is resource expansion, and more importantly, resource optimization. Is we have a better understanding of the structural controls of these deposits. We have delineated a deposit that we call the vault zone, which is a subset of the deposit of the Umwelt, that will deliver grades very close to half an ounce. And what we've looked at internally is resequencing of the mine plan to be able to bring some of those bonanza grades out early. And in the last several weeks, and the latest this morning, we've now shown that armed with that new structural reinterpretation, that we have been very successful on the resource optimization in other areas much closer to surface, with this morning releasing a new drill hole that is based on that reinterpretation. That is one of the best ever drilled at Back River, and that was over 32 meters of just under 20 grams per ton gold. So with all of that, we're going to use that as a basis for updating not only the resource, but more importantly, the mine plan feasibility. In the meantime, moving forward with detailed engineering, moving forward with our pre-construction civils, with being in a position that we anticipate in the first quarter of next year that we will be able to make a production decision. And next slide. So continued drilling results, particularly from this resource optimization program that we're doing today, detailed engineering, continuing, updating that feasibility and resource to current prices, and continued pre-development earthworks to prepare for the underground ramp. All of that equipment has now been purchased. We're now doing a runway expansion, which will allow us to fly in 737 and Hercules aircraft that will support not only construction, but the underground year-round. So, fortunate that we have a great asset, and within this, 50 kilometers away from our Goose project, which all of the economics are that we've spoke about are just from the Goose. We have another 2 million ounces 50 kilometers away that we have not been on the ground on, and will certainly be part of our future expansion and growth. But we're positioned for re-rating, a position to be a mid-tier producer in Canada.
Okay, thank you very much for that, Bruce. Rick, what questions do you have for Bruce?
Well, Bruce, there's another asset in Sabina,
Yes, there is. Yeah.
a sort of a redundant asset. And when people look at Sabina, they forget that you have a second high-grade remote asset in effect for free. Could you describe that redundant asset a little bit and give us a hint as to how shareholders might see value from that? I think it's normally missing in people's interpretation of Sabina.
It certainly has been. It's certainly something that investors have brought up more frequently, particularly when silver has started to move. We own a royalty on the Hackett silver zinc asset, which is about 50 kilometers away from our George project in Nunavut, which is part of the Back River complex. It was an asset that was at one point Sabina's primary asset. It was sold to Xstrata. Xstrata was in the midst of developing that when they were purchased by, or moving it forward to develop, when they were purchased by Glencore. It is one of the highest grade silver-rich VMSs in the world. It is about 75 million tons out of 3.5% zinc and about 110 grams per ton silver, of which when we sold that to Xstrata, we retained a 22.5% royalty on the first 190 million ounces of silver, which is the resource, and that's about 40 million attributable ounces at no cost to Sabina, plus 12.5% thereafter from any future growth. Now, you know, when silver has been $12, $13, $14 and zinc sub $1, it was an asset that some of the analysts that cover us put notional values of 20 or $25 million on, which I think was appropriate. But given where we are in silver prices today, given the lack of true silver opportunity and big bulk tonnage projects, I can see that this project being moved forward in Glencore's chain, and that may be in there to create value. Is I think Ivan Glassenberg has been very clear that Glencore doesn't develop mines, but I think they're also very clear that they take advantage of economic opportunity. And what I see is an economic opportunity for Glencore, which in turn will mean a very serious economic opportunity for us. Based on their production profile, it's essentially almost 3 million ounces a year of production that would be attributable to Sabina once that mine goes into production.
And then finally, you anticipate being able to release a production decision, what, mid next year? Is that?
I would say by mid next year. I'm again, I'm not going to guide for first quarter necessarily, but you know what we're thinking, that by the time we have our bank models, refresh the debt, and get our lenders back on side with a revised mine plan, that we'd be in a position to be able to make that decision by that time of next year.
Well, Bruce, some of your lenders have never been offside.
Well, I know of one in particular, Rick, that has been there, but you know, there's also process that is being navigated today, and there may, in effect, be a means, given the economics of this project, to fast track that from what I've given as what I feel is a conservative timeline.
I'm just advertising. That's all. Thank you.
Joachim, do you have a question for Bruce?
Yeah, so I mean, I really like Back River. I think the economics as you present them, they look very attractive. My issue is only the location, and I haven't been to Back River, but I've been to Medellin, Agnicos mine. I've been to T-Mac just before, I think half a year before they were taken out and all that. And I must say, for me, I've seldom been to such a remote area like those operations in Nunavut. And you presented in your feasibility study, you presented a capex, I speak under correction, $400 million plus minus, somewhere around there. That was 5 years ago.
$25 million for capex.
For 25. So this was at the 2015 feasibility study, and things have changed. Transport has become more difficult due to Corona and so on. Just in order to give us, that we're looking at it from a from the remoteness, wouldn't it make sense to update this feasibility study and introduce more recent numbers? Aren't these numbers a little bit too optimistic anyway, if I look at the other operations that are operating there? So for me, it's really the biggest concern is the remoteness, and that it's very easy to promote this as a very attractive project without actually considering the hurdles that are coming in this kind of environment. Do you think I'm too pessimistic here, or do you?
I think you are too pessimistic, and one of the reasons is we don't just have a paper study with a feasibility. Is one of the things that we have raised capital at a discount to be able to do, because we felt it was so important, was actually build our transportation hubs. So we built our port facility, we built our winter ice roads, we've actually tested our entire supply chain via sea, via ice road, via land, from our consolidation points in Lower Canada to the site. So we have real world numbers, and if you follow our disclosure, our numbers from our 2015 feasibility and what our capital costs were and our operating costs in 2018 and 2019 were within 10% of what our stated costs were in the feasibility. To put it into perspective, this is a 3,000 ton a day mine, not a 30,000 ton a day plant. Mm-hmm. Is the last mine that I built in Canada's north was the Minto mine, and that was a 3,000 ton a day concentrator in the subarctic. It didn't have the transportation hurdles, but it had the same hurdles of when people are on site is 40 below in the winter, blowing snow. And we built that project for just over $100 million versus our feasibility of 425. Now, we've certainly seen some increases since that 2015, 2016 study, but we've also seen some real benefits and 3 new discoveries, and all of those having components of much higher grade. That's why we've committed to, and part of our presentation, and even in the one today, was we will come out with a new resource and a new technical report with those in the first quarter of next year. But the biggest change that's happened since that feasibility is Canadian dollar gold price has gone from $1,438 in that an ounce Canadian in that study to today 2,575 Canadian. So even if you want to put some additional cushion in there, this project today is absolutely a mine. And now you talked about some of the other mines you visited. The Meadowbank mine, which is very similar logistics. It's the same distance from tidewater, the same latitude, the same climate, the same weather. It was a very profitable mine for Agnico, and their head grades of their pits were 3 grams versus 6 grams for ours.
Sure, yeah. Just remind me again on the energy supply that you have here. I don't have that in my mind.
It's 100% diesel.
Okay, that's not too ESG friendly, I suppose then. So.
Well, is solar doesn't work in the north where it's dark 4 months of the year. Wind, the technology is just getting there to be able to work these in winter months. What we are looking at is some of the technology improvements that, particularly when it comes to battery backup, and what that does is effectively, no generator is ever matched perfectly to the end products on there. They're always moving like this. And what the new battery technology allows you to do is produce energy at your mean. And when you have surges above that, it comes from the battery power. And when you have lesser numbers, those battery packs are replenished. And the cost of those is certainly becoming much more in line. But there's more to ESG than energy, and certainly when we look at operating in an Inuit area, the biggest thing for us is having the buy-in from the 5 communities and such strong community support, not only from those communities, but the Kitikmeot Inuit Association and the local and federal governments, which have allowed this project now to be fully permitted.
Okay, great. Thank you.
Right. Thank you very much for that. I think in the interest of time, we're going to move on to our final mining update. And this is from Derek White, President and CEO of Ascot Resources. They are a gold and silver exploration company with a portfolio in the Golden Triangle. Over to you, Derek.
Yeah, thank you, Andrew. I apologize. I'm having some problems with my video screen, so hopefully you can hear me okay. If you could move to slide 4, the presentation, thank you. And I'll just briefly kind of overview Ascot. Ascot is located a little bit south of where Walter is, near the town of Stewart, British Columbia. And this is a brownfield site that's had a lot of historical mining. The Ascot management team came into the company about 2.5 years ago and has been working on effectively restarting it. Ascot has about 12.8 million tons of resource, of which a little less than 50% was put into a feasibility study. Those resources contain around 3.1 million ounces of gold at a reasonably high grades, just a little bit below 8 grams a ton. And in that feasibility study, we identified effectively a restart of this area for just under 150 million Canadian dollars at pretty low, operating costs. And that really drove a very high IRR. And that was at about $1,400 gold. As other speakers have talked about, as the gold price, especially in Canadian dollars, has moved up, that really generated a much larger NPV and a very, very high IRR. And since that time, Ascot really has been working on progressing what's the next kind of level of engineering, which is the pre-construction engineering, advancing its permit amendments, and continuing to try and grow the resources, by doing exploration. The concept that Ascot has put out is kind of a common mill with 4 surrounding mines and some fairly strong exploration ground that are around that mill. If we could move on to the next slide. One of the big advantages in a brownfield site is A, the capital cost, but B, just the timing of construction and permitting. And in this case, there was a mill that was put in place in the past, and this was bought from Boliden, the Swedish mining company, a tailings dam, and you see in the major picture here, power from 2 sources. There's a hydroelectric dam on the site, and a power plant that feeds the Brucejack mine, and a power line that comes in from Stewart water treatment plant, and about a 25-minute drive down to the port of Stewart. So, fairly easy access. And that existing infrastructure combined with the resources just makes the project a lot easier to move along at a fairly quick pace to put back in production. We can come on to the next slide. So in Ascot's case, the land package has kind of grown over the last 2.5 years. And there's really 2 parts to this. One is the premier area, and the other one is the Red Mountain on the other side of the valley. And it's around 25,000 hectares, so it's a fairly large package. And historically, there was a lot of work done here, but there's still a lot of areas that are very prospective and have not been explored. The return numbers here and the speed and the limited amount of capital to get this back into production, and the upside that we see here makes it pretty attractive. The short time frame, and we'll talk a little bit about that. In permitting in British Columbia, I think when Walter was speaking, people were talking about that, and BC has had a difficult reputation. I would agree that the First Nations relationships are very important. This is inside the Nisga'a ground, and we're one of the few First Nations in British Columbia that have an existing land treaty where they're really the landowner, and they've been very supportive and have partnered with us in trying to push, getting the amendments to this permit so we can get back into production. And really, we see that as a strength of the project, and really to grow from there. And so at this point in time, really the main things from Ascot's perspective is, we did a financing in June, so we're fairly cashed up to get all the engineering and everything that's ready in terms of long lead time items to get ourselves back into production. We're very close to be submitting our Mines Act amendment permit applications, and really engaging the next level of engineering, while at the same time continuing to do additional exploration. We have a lot of resources which are not in the mine plan, which are very, very close to being converted. And we think that those are all positive as we move forward. That's a very brief overview, but I appreciate that we're a little bit tight for time, and happy to take questions.
Okay. Rick, what question would you like to ask Derek?
Well, I'd like to repeat to begin with the question concerning the First Nations. If you could talk about the nature of having the Nisga'a, you described them as partners in the mine. How does that work? And how does the impact benefits agreement with the Nisga'a go? Particularly, what would be the intended percentage of employees, if you can disclose that, that would be Nisga'a?
Sure. Well, I'll start with the Nisga'a first of all, and both ourselves and many people in the Golden Triangle, probably the two predominant First Nations are the Tahltan that works with Skeena and the Nisga'a that generally works with us. The big distinguishing factor of the Nisga'a is that they negotiated a land treaty with the provincial government, or with the federal government and provincial government, back in 2000. And so they are actually the landowners, where the law of the treaty kind of overrules the provincial law. So they have a lot of say in what's going to happen legally. And they have been supportive in developing mining projects in the past. They've worked with some more junior development companies. And so we probably didn't invent this wheel. We're just kind of executing along it. And that process is quite well laid out, and it's quite understandable. And there's really two ways you can go about permitting in BC. You can do a lot of work and then submit it to the government, and then they turn around and ask the First Nations what do you think, or you can partner. And what we did with the Nisga'a Nation is we have worked with them and their consultants far before we start approaching the government on what are the issues that are typically important to them. And it's in building that relationship and that partnership that you're able to build trust, and that trust, I think, generates itself into a well understood project when you're going to permit it, which cuts down the permitting time. In terms of the benefits agreement, the benefits agreement really has two parts to it. One is the economic benefit that they're going to get, and that comes out of effectively money that would be paid in taxes, or as Walter talked about, sharing. And then it's really about jobs and how are you going to help employ them. And typically, it isn't really a percentage. We look to try and find jobs for people that have the skills to do that. And if they don't, we try to train them, but they're not insisting that we employ people that are unskilled. So I think they're fairly commercial about it, but we want to try and employ and work with people in the north. And there's not a lot of people that live in this part of the world. So, they become a very strong candidate for working. And we have employed Nisga'a already and have been for several years, and they've worked very, very well.
My second question is much more purely financial. It's pretty clear that every project that's presented today is economic or wildly economic at today's gold price. How do you feel, as part of the financing package, about hedging, which is to say locking in today's gold price, taking away the downside, but also limiting upside? Have you considered hedging, and what is the opinion of the board and also the opinion of your shareholder constituencies with regards to that question?
We're obviously well advanced on discussions for project financing this, and so we're we have many project financiers because we're come much closer to production, and many of them have hedging requirements in there. And I think in my previous life, I've worked with hedges that have gone wrong, where the metal price goes way above the price that you hedged at, and effectively you're just adding more debt onto your balance sheet. I think where we're at is we obviously don't want to hedge where we don't have to, and we look at it more as price protection, because you're right, like in Canadian dollar terms, gold prices are probably as high as they've ever been. And so what we're looking for are structures where we can still participate in the upside without giving up too much of the downside. And I don't think an outright straight hedge is something that we need to do at this point in time. But if there are opportunities for reasonable levels of money, and I'll use a gold kind of loan, as it where you're effectively selling gold up front at a period of time. There are some considerations around gold loan type structures that offer you more flexibility than just a straight hedge. And I think it's in those kind of structures that we don't need to do, but we certainly can look at.
Thank you.
Joachim, do you have a question for Derek?
Yeah, just a geological actually this time. So prior to Ascot taking out IDM, I had a close look at the IDM deposit at Mark Zone, AB Zone, and the JW Zone, and I was intrigued by the lack of cohesiveness here. I mean, these were 3 blocks changing dips within the ore bodies and so on. And this seems to be a theme that's going through this area where you're operating. How do you deal now? I mean, you've got your project lined up, you want to build some mine. Are you going to drill more? Are you going to do more exploration, trying to find these blocks of mineralization, which are structurally quite complex in detail? Or is exploration a little bit on the back burner, that you say, look, let's first build some mine and work with what we have before we go into more exploration?
Well, Joachim, I think we always try to do both things at the same time, because there's just so much opportunity here. And I'll probably answer your question in 2 ways. So on the exploration side, we started exploration drilling in June. We identified an area west of Premier that looks extremely attractive. We were hitting, we had some zones up to 40 grams a ton. And we've also identified another area west of Big Missouri. And there are kind of regional trends that run along our properties that, we need to continue exploring. Even if they don't make it into our feasibility study at this point in time, they will add value into the future. And so, we won't stop doing that. Having said that, we will continue to do all the work to building the mine. So I think you have to be able to do both things. And certainly Ascot is doing that. In terms of, kind of the high level geology, there are certain kind of hydrothermal and epithermal fluids that moved along certain structures on our properties, and they did get faulted up and moved around. And this is an area of different kinds of faulting, and it's just being able to follow those things and making sure you understand where you are. And many people on this call, I mean, our assets have been around for a long time, but there still are areas where we see continuity of these quartz breccias, and an ability to understand how we could ultimately bring that into the mine plan. So, definitely we're continuing to work on both, and we think that is worth doing, because although everybody might be focused on when are we going to bring this into production and when does the permitting amendments happen, there's still tremendous value here. And, this part of the world is just blessed with a tremendously high grade gold geology.
Yeah, sure. How much do you spend on drilling? How many meters do you want to drill this year?
We'll do plus or minus around 20,000 meters this year. And, we're conscious to be, COVID good stewards. Unlike some other companies, we bring people back into Stewart every day, and we are conscious about COVID. And so we reduced the crews initially until we kind of got that down, and we've started to ramp that up in August. So, we have more drilling going on, and this year our targets tend to be lower. So we'll probably continue drilling well into October.
And how much do you want to spend? How much do your exploration expenditure?
Well, roughly speaking, it'll be about $4 to $5 million.
Okay. Thank you.
Well, thank you very much for that. And thank you very much, Derek. I think we are out of time. So all that remains for me to do is to go and thank our 5 mining guests for this Sprott 5 at 5 show, our 2 investor guests as well. Also Sprott, our sponsor as well. I hope that you enjoy the show, and I look forward to seeing you next time. Thank you very much.